Welcome, everyone. It's great to have you here. Today happens to be the second session in continuation of the previous one where we started discussing the risk and reward matrix. We are going to crack one formula today, and it might be one of the most important in the whole level one portfolio management syllabus. And that is called capital asset pricing model, CAPM for short. And we are building this from scratch. You do not need to have a background about this. There is no memorizing involved. There's every symbol one at a time. We are going to build the whole thing from the scratch. So let me give you a quick recap. We had this series is actually a 3 session series. In session one, we build the efficient frontier. We learn to combine assets, diversification, kills off risk you don't get paid for. So, for risks which you can actually diversify, the market is not going to reward you for those risks. So, you need to learn how to diversify them. And obviously, for risks which you take, which you can obviously diversify, market will never compensate you for those. And now in the second one, we found what survives. So one risk never goes away, and that is market risk. And here's the key line, it's the only risk that earns you a reward. So this raises a question, if market risk pays you back, exactly how much does it pay? And that is what we are going to address in the session today. And that's the whole game. And what we will be doing in today's session is we are going to put a precise number on the reward, look at the question, and we'll figure out. And that is what the framework CAPM, CAPM answers. Now look at the screen. E of R equals RF plus beta times the bracket E of R M minus RF. And let us get all of these numbers. What do each of these numbers actually mean? So while you get the equation here very correctly, so this is what we say is the expected return. So expected return is equal to the risk-free rate, and you combine that with the summation of beta times the expected market rate minus the risk-free rate. So if we expect to get a return calculation for the market risks that we are taking, then these are the numbers which we should be aware of. You should know what is a risk-free rate, and in our detailed session, we'll be getting into each of these, but we should know how to derive risk-free rate, then how to derive the beta, and then how to derive the market rate of return, and then the risk-free rate. And when you start combining all of this, so what this actually answers is you are trying to calculate the required rate of return. You're looking at the risk-free rate of return, you're looking at the beta, and then you're looking at the market risk premium, right? So what is the market risk premium? What is the risk-free rate? And what are the sources from where we should be able to draw this? You combine all of it and you get a number which actually tells you this is the required rate of return. And we will look into each of these components one by one. So let me again take you back. When you look at these components, when you look at this equation, it should not disturb you. You should not panic. It looks there's a lot on this equation, but in reality, if you look, there are actually just 3 components, or the fourth component is just the equation you're going to derive. So you have a risk-free rate, and then you have beta, and then you have the expected market rate, and then you have the risk-free rate. And we will look into all of this one by one to understand how these are actually calculated. Now let's look at the first one, the risk-free rate. Now let us picture this. the safest thing you can buy, a short-term government bond, almost no chance of losing your money. So any of those opportunities which come by way of an investment, which the government, so if the government, if you're lending money to the government, it is supposed to be secure. They are considered as the safest investments you can have. But again, when you look at multiple governments across the world, the risk perception of one government compared to the other could vary. But depending on the location where you are, if you are investing in any security which is issued by the government, that is supposed to be a lot more secure, a lot more safe. So a short-term government bond, almost no chance of losing money. Now, what does it pay you? Two things really. When you look at any of these securities which are issued by the government, what does it pay you? It pays you two things really. One, the time value of money. Because what is happening when you invest in any of the securities issued by the government, what you're doing is you are shifting your consumption from point A to point B. This is what you end up doing. So if you have the resources, instead of investing those resources in consumption right now, you are avoiding the consumption right now, pushing it into the future, and you are parking someone. So there is a time value of money which is involved, and you need to get paid for waiting. And that's a fair ask when you are putting your consumption, which you could fair well do it right now, but you are pushing it into the future. And the next part is the inflation, because inflation is something which eats into the value of money. Without getting into the definition of inflation, your money, if you leave your money, do not invest it, your money on its own, because the cost at which certain things could be bought for a basket of portfolio of items, they become expensive with time. So there are two things, let me summarize, which you need to be compensated for. One is the time value of money for you to push your consumption from now into future, and second is expected inflation. And that is what any risk-free rate should be able to compensate you. So when you are looking at a risk-free rate, you are essentially considering a situation where you park your money to someone where the ability for you to lose the principal is close to zero. Why I say it's close to zero? Because there is always a chance that you might lose your principal. But when it is the government and it's a near term, it's a short term investment in any of the government bond, your probability of losing your money is very limited. And that is why we say it's a very safe investment. So even if it's a safe investment, there are two items on which you require return. One is your time value of money, and second is your expected inflation. And you need to put a number on it. Say a 1 year government bond yields 4%, then your risk-free rate is 4%. So if you are in the US and you look at any of those securities being issued by the government of US, which is a short-term government bond, and you look at the return matrix which is appearing across in front of those bonds, that risk-free rate is the rate which tells you that this is a government bond and it is quoted at say 4%, then your risk-free rate is a 4%. It's very simple. It's essentially finding the right reference, and that is your risk-free rate. Now let's look at the second term, and that is the market risk premium. And this is the heart of the whole thing. And the logic is the whole market, all the stocks together, is way riskier than a government bond. So why would anyone hold it for the same return as the safe bond? Let me phrase it once again for you. If the entire universe, the whole market, all these stocks opportunities which are available for investment is way riskier than the government bond, there has to be some form, some reason for you to move away from the safe bond and park your money in, say, any other opportunity of investment that comes your way. And that is what you mean by saying it's the market risk, is the market premium, and that is what you should be compensated for. And that is an extra return. So if you were looking to steer away from investing in a risk-free and moving your investment into another opportunity, which is way more riskier, then there has to be some incentive to do that. And that incentive is what you call as the market risk premium. And that's the market's expected return. So you subtract the risk-free rate, what is left behind is the premium. So if you start comparing, say, for instance, if you compare, there are two opportunities to invest. One is risk-free investment completely, and you are getting 4%. Then for you to move away and put your money on another option which gives you, and there are risks involved, it is not risk-free. There are risks involved. And you look at, say, for instance, 8%. So you remove 4% from this. So 8% minus 4%. This delta of 4% is your risk premium. Or you could take any example, and these numbers are not going to remain constant depending on the geography where you're operating. If it is in the US or it is in the Asian markets, this market risk premium is going to vary depending on the geography where you're operating. And now we look at the third term, which is the beta. And this is a statistical measure, the third term. And most of you will get nervous here. But beta answers one simple question. When the market moves 1%, how much does your asset move? It's a multiplier. It's not a percentage. It's a multiplier. And let us look at this. Let us evaluate this using three examples. Beta is equal to 0, beta is equal to 1, and beta could be greater than 1. So when beta is equal to 0, it moves with the market. Is a risk-free asset, no market sensitivity. It's like cash. When beta is equal to 1, it moves with the market exactly, note for note. So the market's own beta, a broad index fund. And if beta is greater than 1, that means it amplifies the market. If the market moves a beta of 1.5, it swings 1.5 as hard up and down. So that is what beta says. How do we calculate beta is not something we're getting into it, but the way you compute beta, the formula for it, it is the covariance of the, firstly, it's the covariance, a statistical measure looking at covariance of the asset compared to the market up on this coefficient of variance as a standard deviation. So we are looking at this. We will get to understand how we calculate this in a separate session. But that's the whole and soul of it. So beta is actually allowing you. So where does it come from? It's the asset's co-movement with the market divided by how volatile the market is. You won't calculate that by hand at level 1, but you must know what it means. So more co-movement means it's a bigger beta. And then we get into the last term, the fourth term, where we place all of this together. And how do you do this? You have got three pieces. Beta tells you how many units of market risk you carry. The premium tells you the price of each unit, and the risk-free rate, that's your floor. So you multiply beta by the premium, that's your total risk reward, then add the floor and you are done. And that is how the whole thing works. Now, let's go back to this whole structure. I have given you the way to calculate this whole thing. That's the way it is supposed to work. And let me package it once again for you. And that is term 4. So you already have the three pieces: the risk-free rate, the beta, and the expected market return. So multiply beta by the premium, add it to the risk-free rate. That is the floor that you're adding. And you look at the formula: the risk-free, the floor, the beta, the amount, the bracket, that's the price. Three parts, and you have all of them pieced together. So once you have this piece coming in, and you also have the beta, the calculation, the statistical measure in place, and you have the risk-free rate, you bundle all of this together, and that is the expected return that you'd like to have. We now move on and we look at a worked example. In this example, you have a risk-free rate which is 4%. So you have a risk-free rate which is 4%. The market expected return is 10%, and the beta of the asset is 1.5. Now, what it really means is if you take the premium is the first component you calculate is the premium, and the premium gives you a number of 6%, which is 10% minus 4%, you get the first number. The risk taken 1.5 into 6, which is 9%, and you add the floor, which is 9 plus 4, and together you get 13%. And that is how you do the calculation for the expected return. Let us look at this again. Do this. So step one, that's the premium. How do you calculate the premium? 10 minus 4. 10% was the market return. The premium 4% is the risk-free. You deduct 4% from 10%, you get 6%. 6% into beta, which is 1.5. You multiply that, you get 9%. And then you add the floor, which is the risk-free rate. So 4% plus 9%, you get 13%. Now, what does 13 actually mean? This asset swings 1.5 times harder than the market. So there is more risk. So investors demand more, 13%, a full 3 points above the market's own 10. Now, and you notice the word required. 13 is the hurdle. If the asset's actually expected to beat 13, it's a bargain. If it falls short, it is overpriced. And you hold that thought, it's our next move. And that is what we are going to do in the next slide. The security market line. And let us draw this, because a formula you can see is a formula that you understand. We put beta on the bottom, required return up the side, then we plot CAPM. And when you look at this, so you have the risk-free rate here, 4%, which is at this level. And our asset is somewhere here, which is at 13% because the beta of it is 1.5. And the market beta is equal to 1 is 10%. Now, when you look at all of these 3 points taken, beta 0, that's the risk-free asset, 4%, bottom left. Then you have beta 1, that's the market, 10%. And then beta 1.5, that's our asset, 13%. The one we just calculated, 3 dots, 1 straight line, and that's the model which we call as the security market line. So on this, when you look at this graph, as you move right, you're taking more risk because the beta keeps on improving, increasing. And the line tells you the return the market demands for that risk is steeper line, higher premium. And that's the way to look at this, the security market line. Now, let me give you a big warning. The x-axis here is beta, not a standard deviation. And that's what makes this different from the efficient frontier chart. And the examiners love to test exactly that. So when you're attempting your exam, they are looking for you to have an understanding that the x-axis here is actually beta. It is not standard deviation. Beta on the security market line. You need to remember this and understand this thoroughly. Now let's get into the follow-through concept, and that's the payoff. This is where CAPM earns its keep. The line gives you the fair return. So what if a stock doesn't sit on the line? Then the market's handling, there could be a situation where the market is somewhere giving you a return somewhere here or somewhere here. So if that stock doesn't sit on the line, then the market's handling your deal could be a good, could be bad, and you got to look at both the situations. If it is above the line, the green dot, this stock offers more return than its risk demands. It's a gift, it is undervalued. And what happens if it is below? Then it is overvalued. So when you look at those stocks which are above, investors put more money on those stocks they buy. Buying pushes the price up, and as the price rises, the return again falls right back down to the line. And that is where each of the stocks down the line are supposed to be mapped into. Now, below the line, which is here, if something is falling this place, you're looking at the red dot. This one pays too little for the risk you are taking. So the risk is there, but you're not being rewarded proportionately for the risk that you're taking. It's overvalued. So investors end up selling it. And as they start selling it, there is a drop in the price. And as there is a drop in the price, there is an increase in the return. So lower price, that means higher return, and the stock now goes back up to the line. So what it actually means, CAPM isn't abstract. It's the yardstick above the line. You buy, below the line you sell, and that's how analysts call a stock cheap or expensive. That's the key takeaway that we're going to have for this session. Now, where would CAPM, the structure, the framework that we just discussed, where would this CAPM actually break? And there could be three situations where it is. First, it's a one factor model. It says beta explains everything, but reality has more going. There could be size, value, momentum, and in the subsequent later models, we'll bring all of these components together. The second, it leans on ideal assumptions. It leans on there will be no taxes, no trading costs. Everyone borrows at the risk-free rate. None of that is quite true in real life. So the assumptions that the CAPM model actually has, those assumptions are not going to hold in the real marketplace. And third, beta isn't stable. It drifts over time. So a stock, when you do the calculations for beta on day one, 10 months down the line, the calculation, once you use the fresh numbers, the beta could vary because it's backward looking. And you're using a backward looking number to predict something which is happening in the future. So a beta you measure from the past might not hold in the future. So why do we still teach it, and why does it matter? Because it is the foundation. Every richer model in finance starts by fixing one of these CAPM assumptions, and you cannot skip it. And it's the single most tested formula in level one portfolio management. You need to master this, and a whole chunk of the exam opens up. And one more thing, knowing where a model breaks, that's not a weakness, that's a skill, and the exam is going to test you for that as well. Now, we'll summarize the key takeaways. And this happens to be the last slide on this. And let's lock in what you can do now. After this session, you should be able to read the formula, every symbol, and what it adds. Can you build it from parts, the floor plus beta times the premium? Can you compute a required return from three inputs, like we did, all the way to 13%? Can you interpret beta 0, 1, greater than 1? And we discussed this in mid of this presentation. And can you apply the security market line to call a stock undervalued or overvalued? If any of these feels shaky, that's your revision for tonight. And it's exactly what to bring to the Q&A. Now, we have spent roughly most of the time discussing this entire thing. In case you have any question, please feel free, drop in a text or an email, and I'd be happy to come back to you. Thank you for joining us.